And thank you for your interest, thank you for your time, and looking forward to updating you on Aris Mining and the progress that we've been making in building the next leading gold mining company in Latin America. Before I dive in, let me quickly kind of point you to the disclaimer, given that I'll be making a number of forward-looking statements today. Aris at a glance. We are a Canadian company incorporated in British Columbia, headquartered in Vancouver and Bogota in Colombia, and listed on the TSX and the NYSE with a market cap of around $816 million as of yesterday's close, US. The company has two operating assets. Both are wholly owned, Segovia and Marmato, and those two assets produced 211,000 ounces of gold last year. We're currently in the process of expanding both of these assets, which will get us to a production rate of more than 500,000 ounces per year within the next 1.5 to 2 years. And that growth is near term, as I will show you in a second. Actually, it starts to materialize from this quarter onwards. We expect to deliver the expansion of Segovia this quarter. In addition to that, we have 3 greenfield development and exploration projects in Colombia, Guyana, and Canada. And across those 5 properties, we have 7 million ounces in proven and probable reserves, 19.9 million ounces in measured and indicated resources, and an incremental 10 million ounces in inferred resources. So in terms of key investment considerations, I've already touched on the first 2. 1, extensive gold resources, which are the lifeblood of any mining company. 2, the significant transformational near-term organic growth, more than doubling the size of the company. The other important thing is we have a business model by which we partner with local contract mining companies. And that is not just an attractive business to us financially, it also helps us de-risk our position in the country, and I'll tell you more about that in a second. Then we have the financial strength to deliver our growth. We have, as of the end of last year, had $253 million cash on hand. Segovia generates meaningful cash flow, particularly in the current gold price environment. And then we have warrants outstanding that are in the money that will mature at the end of July. If they get fully exercised, they would result in a cash inflow of $110 million US. And we also have 2 remaining installments from Wheaton that are to be funded to us as we make progress with the expansion of Marmato, and that would result in an incremental inflow of $82 million this year and next. And ultimately, we have the leadership team to deliver on it. This team has done it multiple times before. Our CEO is Neil Woodyer. He has previously founded and led Endeavour Mining and grew it from 0 to a $2 billion market cap company before handing over the reins to the next management team. Then he and his team founded Leia Gold, grew that from 0 to $800 million market cap before merging it into Equinox Gold. And Aris is the third stint. And if he were here today, what he would tell you is that compared to Endeavour Mining and Leia Gold, at the same point in time, let's say 4 years into the company build, this is the strongest asset base he's ever had to build a company from. And that is because of the significant reserves and resources that we have, not just in terms of scale, but also in terms of grade. So first, I'd like to draw your attention to Segovia, that we have 3.4 million ounces in measured and indicated resources at a resource grade of 16.1 grams per ton. Our reserves are 1.3 million ounces at a reserve grade of 10.8 grams per ton. So it's one of the highest grade gold mines in the world. And as you know, there are many economic factors that determine the economic attractiveness of an asset, but clearly grade is king in that regard. We are right now in the fortunate position of finalizing the expansion of Segovia. We're increasing throughput capacity by 50% from 2,000 tons per day to 3,000 tons per day by way of debottlenecking the processing plant. And that expansion project will get delivered this quarter, and then we will ramp up over the remainder of this year. and such that we should be reaching 3,000 ton per day throughput capacity towards the end of this year. And that gradual ramp-up drives our guidance for this year of gold production of 210 to 250,000 ounces from Segovia, and then 300,000 ounces next year, which is based on the assumption that at that point we will be continuously operating at 3,000 tons per day. And that compares to 188,000 ounces of gold production from Segovia last year. So it's really exciting to be able to be delivering those incremental ounces into record high gold prices. And to give you a sense, last year, Segovia generated an all-in sustaining cost margin of $163 million. When we came out with our guidance for this year, at the beginning of the year, we used a conservative gold price of $2,600 per ounce. Based on that assumption, the all-in sustaining cost margin for this year was estimated to be north of $230 million. And if you do the math based on our guidance and use a $3,000 per ounce gold price, the all-in sustaining cost margin should be approaching $300 million. And, that's a function of, one, delivering more ounces in record high gold prices, but also fixed cost regression as you're spreading the fixed costs, which are significant at Segovia, over more ounces. At Marmato, the story is a bit different in the sense that at Marmato today, we're operating the upper mine, and the upper mine is a marginal asset. It produced 23,000 ounces last year at high all-in sustaining cost. But what's really going to drive the transformation of Marmato is building the lower mine, which we're currently doing. And the lower mine is going to tap into a different type of mineralization. The upper mine is an epithermal system that has created a narrow vein structure. The lower mine, on the other hand, is a porphyry system, which will be mined by way of mechanized bulk mining, by way of long-hole open stoping. And so that's going to be really productive, low cost, and this is going to be a 5,000 ton per day operation. We expect to deliver that project in the second half of next year, and then we will ramp it up over the remainder of that year and early 2027. And once fully ramped up, the upper and the lower mine together are expected to have a potential to produce 200,000 ounces of gold or more. And so those two assets get us from 211,000 ounces last year to 500,000 ounces this by kind of like we should be hitting that run rate by 2027. In addition to that, we have greenfield projects. Soto Norte, in our view, one of the best undeveloped gold projects in Latin America. And I'm saying that because of the resources and the grade, 8.5 million ounces on a 100% basis of measured and indicated resources. We own 51% of it. Our joint venture partner there is Mubadala, the sovereign wealth fund out of Abu Dhabi. And the grade is significant too, 5.5 grams per ton. We are planning on publishing an updated pre-feasibility study in the middle of this year, which will then showcase to the market what we think this asset could do. And then Toro Peru is another greenfield project. This one is in Guyana. It's a gold copper project, open pit, 5.4 million ounces at a grade of 1.5 grams per ton. So quite attractive grade for an open pit project. We will be doing a PEA there, and we expect to deliver that PEA either towards the end of this year or early next. So said differently, there are going to be catalysts associated with each and every one of our assets this year. And 2025 is shaping up to be quite a seminal year for Aris Mining as we deliver on the first leg of the growth strategy. Just to put this into perspective, right? We've benchmarked ourselves here against the peer group as we're defining it. And the first observation I would make is that we are at the bottom of that peer group in terms of market capitalization at $800 million. And clearly there's a tremendous amount of re-rating potential as we deliver on our growth. Companies that produce 500,000 ounces have market caps that are measured in billions, and even companies that are smaller today than we are already valued at multiple $billion. So the re-rating potential is there, and we expect to see it materialize as we deliver on our growth, and the market sees the incremental ounces and the incremental cash flow that results from it. So now I want to spend a minute on the CMP business, our collaboration with contract mining partners. Those are small-scale mining groups, small-scale mining companies that range in size between 50 to 500 employees. And we have a contractual relationship with them. Pursuant to this contractual relationship, we buy mill feed from them based on a formula that's linked to the tonnage they deliver, the grade of that tonnage, and the prevailing gold price at the time. And that part of the business accounts for 45 to 50% of Segovia's gold production, so meaningful. And the all-in sustaining cost sales margin that we generate with that business ranges between 35 to 40%. So think of it as a fixed margin business, right? And in a $3,000 per ounce gold price environment, if you take the midpoint of that margin range and you kind of take the midpoint of our production guidance for this year, you get to an all-in sustaining margin from that business alone of $129 million. So it's very attractive business to us. But it is not just attractive business to us, it's also attractive to the contract mining partners. And let me explain to you why. If those contract mining partners were to process the ore on their own, they would get recoveries of 50% or less. At Segovia, we have a recovery rate of 95%. So we're making the pie that much larger in terms of total gold production. And that is what puts us in a position to design an outcome where they are better off and we're better off, right? In addition to that, now that they have become part of the formal economy, they can now open bank accounts. They qualify for social benefits. So effectively, this partnership uplifts an entire community. The government benefits as well, in the sense that now that these contract mining partners have become part of the formal economy, they start paying taxes, royalties, comply with labor laws, right? And the environment is a beneficiary because if those informal miners were to process the ore on their own, they would use mercury to get the gold out of the rock, and then they would dump it off into rivers, polluting the environment. When we take care of the processing, there's no mercury involved. The reagents that we use get properly neutralized, and then we dry stack our tailings at Segovia. So said differently, when we take care of the processing, it is clean and it's safe. And that results in a lot of environmental damage mitigation. So this business model is truly mutually beneficial to the contract mining partners, to the government, to the environment, and to us. And that is what results in us being seen as a responsible corporate citizen who delivers a net benefit to our host community. Right? And that is ultimately what protects our social license to operate. And clearly that's critical. When you have assets of such size and scale and longevity, you want to make sure your host community welcomes you for decades, not just a few years. Is this working? Here we go. So next one, financial strength. As of the end of last year, we had cash on hand of $253 million. As I've mentioned, $82 million of stream funding that's remaining from the Marmato lower mine stream that we have in place with Wheaton Precious Metals. Significant cash flow generation of, it's a function of which gold price you want to assume. If you want to assume $2,600 per ounce, then Segovia should be generating an all-in sustaining cost margin of $230 million this year or thereabouts. If you want to assume $3,000 per ounce, that's close to $300 million, right? And then on top of that, as I said, there are warrants outstanding that are in the money by about 25%. They mature at the end of July, and if they get fully exercised, they result in a cash inflow of $111 million. The long-term debt structure that we have requires insignificant quarterly amortizations of about $4 million a quarter to pay down the gold-linked notes. They will be dealt with by August of 2027, at which point the only debt instruments that we have on our balance sheet will be the senior unsecured notes of $450 million. The net leverage is low at 1.5 times, and our credit ratings are stable, being rated B1, stable outlook, or B+ by each of Moody's, Standard & Poor's, and Fitch. And we have strong supportive shareholders. Mubadala, the sovereign wealth fund out of Abu Dhabi, is our largest shareholder at 9.2%. VanEck, by way of JDX and JDXJ, own about 8%. MM-Cap, Copernic, Invesco, Ruffer, and our CEO, Neil Woodier, round out the remaining top 7. Talking about management, I had already alluded to the track record of that management team, and I consider myself very fortunate that I was able to join that team a year ago, right? It's a team with a track record of success that has done it multiple times before. And what you see here when you look at those logos on the right-hand side is that a lot of those team members have been working with one another for a long time, right? So there's a lot, I think that points to like a strong culture, a lot of shared success, and people who not just like to work together, but are very successful at it. Importantly, we also have an exceptionally strong board. Ian Telfer, the former CEO of Goldcorp, is our chair. David Garofalo is our chair of the audit committee. And we have 3 Colombian former ministers on our board. Monica, Gonzalo, and Jaman have either been ministers or vice ministers of justice, finance, and mines and energy. And they give us a lot of connectivity into the political landscape in Colombia. Clearly, we don't want to play politics, but ultimately you want to be connected to everybody. And there have been great advisors to Neil as he manages our relationships in the country. Lastly, to wrap things up, Aris Mining is pursuing the same buy and build strategy that has been pursued by Neil when he built Endeavour and Leia Gold. And when you look at this, we've been quite active putting things into place. Over the last 4 years, we have done 4 M&A transactions. We're currently doing 2 builds, right? The expansion of Segovia, the construction of the lower mine at Marmato, and we have done 2 capital markets transactions. And we expect to continue to pursue this strategy going forward. For now, the emphasis is on building. We're laser focused on delivering those 2 expansions and get up to 500,000 ounces. But at some point, the emphasis will be swinging back to M&A, because ultimately the goal is to build a company that can produce 1 million ounces a year, and effectively the goal is to build the Endeavour Mining of Latin America, right? So that's what we've set out to do. Thank you.
Thank you very much, Oliver. Any questions?
Just wondering, you said that current Segovia operations are about 50-50 CPM and owner mining. When you expand from 2,000 to 3,000, what do you envision the split being?
We think the split will stay somewhere between 45 to 50% CMP and 50 to 55% owner mining operations. So effectively what that means, of the incremental 1,000 tons per day, about 500 tons will come from our own upsize operations, and the other 500 will be allocated either to CMPs that we're already working with that want to grow as well alongside us. There are also some other new CMPs that would want to become part of it, right? So it's a combination of those.
Great, thanks.
Hi, I follow Zhejiang Mining and what they're doing in Buritaca. And how would you compare their experience there with what you're doing, and how come you're getting such different results?
Because it's the polar opposite, right? So our business model is not just about coexisting, but collaborating, aligning interests, embracing the communities, and uplifting the communities. Whereas Zhejiang's approach was to push them away, to basically say, these are our tenements now, get lost, right? So look, when you are operating in emerging markets, I think you've got to listen very carefully to your host communities, and you've got to listen to them and figure out what matters to them. And this business model has been carefully calibrated over years. in order to create a happy equilibrium, right, where we can all succeed together. And I think that is something that Xi has not done at all.
Can I maybe just add one question to that related? It'd be useful if you could give some colour on operating in Colombia, and you mentioned the political situation there. I think there's been some challenges historically, but from my understanding is that the government's trying to encourage a move away from coal, which has been the predominant commodity that's produced in the country, towards copper and gold. Is still the case? And are there any other kind of challenges that you're facing from a political perspective?
So, look, I think the first thing to say is this is the first left-wing government ever that has run Colombia, right? And investors got concerned when they took over power based on the promises that were made on the campaign trail, right? Almost 3 years into the administration, though, remarkably little got done, right? And that's not because of a lack of trying, but because the executive branch got either blocked by judiciary or by parliament, right? So I think what's very much misunderstood about Colombia is the political stability that this country has by way of a very well-crafted constitution that actually mirrors the one in the US in many ways. And the other thing is there's never been a dictatorship in Colombia. There's been a track record of peaceful transition of power, and every president is only allowed to run for one term, right? So a lot of that political stability is overlooked, right? And yes, I appreciate there have been a lot of headlines and concerns as a result of that.
Much, Oliver.
Thank you for your interest.
Yes.